again, and I appreciate everyone coming in to have a listen to 6 things to know about the PNG economy, or PNG itself. 6 things in 20 minutes. It's going to be a bit of a lightning tour, but I promise to keep it tight and get it there for you. I've been going to PNG now for over 20 years, so I've seen a few cycles and a few changes, seen it grow and expand, and I really feel that I do this out of a sort of a desire to really think that there's opportunities in Papua New Guinea. I help push Papua New Guinea with inside of Westpac. I believe there's opportunities there for us to not only grow and be profitable, but also to help PNG itself develop and grow. So 6 things we need to know. First of all, the global economy is looking very constructive. I'm positive in the global outlook and how it will help PNG grow. We're past the peak of global inflationary pressures. Some reasons to think about inflation being sticky, but that big surge in inflation is past us. Transition away from the carbon-based economy is happening. It is real. We can have debates about how much we need to do, where it needs to go, but it has significant implications for what is happening, how things are evolving in the global economy and the price of commodities. Resources do dominate PNG in the big cycles, but please don't forget the domestic economy. It actually matters quite a lot, and I'm going to talk about that. Kina is a managed currency, which provides some degree of stability, but it is overvalued, and we are going to be experiencing a gradual depreciation. And yes, it is a problem with FX. There is a lack of liquidity in the FX markets in PNG, lack of foreign exchange, and that's leading to an excess of Kina in the system. So I just want to highlight those issues. So first off, the global outlook, and it's looking more constructive. Yes, we've had some big swings in the global economy. We had the GFC that hit us, and we had the COVID period that hit us. We've seen the big strong recovery. COVID was a massive supply shock that everyone misunderstood. I did too. I didn't really appreciate what happens when the governments around the world shut an economy, how businesses react, and then what happens when it's reopened again. Never been experienced before in human history, that kind of shock, where an economy is shut and then it's reopened, and how businesses adjust to it all. We underestimated just how resilient economies would be, and then underestimated how fast they would bounce back and how much inflationary pressures it would cause because businesses thought it would be more permanent and created supply chain issues. That's all past us now. Also, please do note that during the COVID period, China was the only country in the world one of the few, but the only major economy in the world that actually continued to grow. Yes, they were then hit by COVID shocks last year again, which resulted in them shutting down again, but again, they still continued to grow. Yes, China is refocusing itself. It's no longer the big investment powerhouse in terms of growth around infrastructure, but it's focusing more on developing high-end technology, more focused on developing the consumer-based economy. So it's going to be a slower, more steady growth. And just quickly, let's just finish off about China. There's a lot of discussions around the debt that's allocated within local governments in China and how that was used to develop and how that's not happening anymore. That is true. There's a lot of issues around those debt. Japan had one way of dealing with the high levels of debt, basically putting it onto the government's balance sheet. China's doing something similar but different. China is taking debt away from bankrupt institutions, creating a special vehicle, and then that special vehicle just drives off into the sunset. They're actually managing their debt in a very structured way, which is different because they run a closed, managed economy. And yes, the debt, there's people losing money and there's losses around it associated with it, and there's going to be constraints around growth. But is China about to blow up in a massive debt bubble? No. Is debt an issue in slowing their growth down? Yep. So that's probably a better way of thinking about it. And of course, we're now talking about the US economy in the developing world. We've come through the COVID period. We've seen the stimulus. We're now seeing the growth hits being put on, the brakes being put on through tight monetary policy. And we're now seeing the other side. We're looking at rate cuts through the next 2 years. So the next couple of years are shaping up to be quite reasonable for growth. So little red bars of the developed world just tonking along. China's adding a little bit more, not as much as it did in the past, but still, it's a massive economy, so even growing at 5%, it's giving us solid growth, and the emerging markets. So think more around stable demand growth. That's a good backdrop for PNG. We are past the peak in inflationary pressures, and I want to talk very just briefly about that, and why we're past it, and what it means for next, because it's really important to think about inflation because everyone panicked when we saw the high inflation. Central banks responded, and they responded very aggressively, and we've seen globally inflation come back down. In fact, core inflation in the US now is running around 2%. So we've seen that pulse. Now, I will talk about some issues along the way about some that are being raised that means inflation could be a little bit more sticky, but we want to get through the idea that the big pulse of inflation passed us. And there were a lot of questions raised during this period of time that we knew it was all about supply chains and supply shocks. This chart on the left is just highlighted. I'll just go back quickly too. I didn't mention it, I need to. Also notice the red line, how PNG has its own volatility and its own cycles around inflation. It tends to run at a higher level of inflation than the globe. And it didn't get the same sort of degree of surge in inflation that we saw around the world. But we're now seeing the impact of disinflationary pressures coming through now. So we probably are past the worst of the inflationary pulse for PNG. We have a managed currency, so you're not about to get an import inflation. And globally, inflationary pressures are down. Chart on the left is just highlighting what we see in terms of freight rates around the world and container rates. Yes, PNG, like Australia, even Australia is a small economy in the global sphere, and our freight rates are still remaining elevated. They've come down, but still high relative to where they were pre-COVID. But this will shift over time because we've got a global economy that is slowing. That's the chart on the right-hand side. You can see the global trade is more around normal levels after being very aggressive post-COVID. Those ships that have been all brought online to deal with that services in an environment where central banks, yes, they can't fix supply chains, but they can crush demand, which is what they did. Raised interest rates, crushed demand, and we now see global trade back to around normal levels. Also seeing that supply chain disruptions are actually the least we've seen in most recent history. So all those supply chain disruptions disappeared around the world, and we're now seeing in places like China, prices for certain goods falling. Car prices around the world are falling again as we see the supply chains improve. So put it in a nutshell, we're past the worst of inflation. There are, however, some reasons to think about inflation remaining sticky, and I'm going to come into that in a second. One of the things that we do accept, and it's irrevocable, and this is why we're going to have some stickiness, is we are transitioning away from a carbon-based economy. We're seeing it around the world now, and regardless of what you think about it, every major bank in the world has signed up to reduce the carbon content in their books, in the lending books, i.e. they have to have less carbon per dollar they lend out. All major banks have signed up for it. So what you're seeing around the world now is investment moving away from carbon-based energy. You're seeing less investment in coal, you're seeing less investment in oil, you're seeing less investment in a whole lot of structured things. And the reason this is unfolding is because the source of where all things coming from is predominantly growth from China, and we're seeing the Western world reduce their output of carbon. This is something that has to continue to go on with. You're also seeing too on just how much work needs to be done on current policies. We will not make net zero by 2050. We need far more aggressive policies than what we've currently got. So keep that in the back of your mind of what could develop over time, more aggressive policies than we've already got. The focus will be on energy. That's where most of the carbon does come from, so how we use energy. There is steel production, manufacturing, industry, but most of it is around generation of electricity and transport. And just finally, just looking at in terms of how energy is being produced, it really is the nature that you can see we're going to be still on these kinds of projections needing carbon-based energy for some time to come. Now I'm going to use a couple of charts just quickly from Bloomberg New Energy Forum, just highlighting how much work to be done and also why I'm not about to stand here and say, get out of LNG, get out of oil, get out of coal actually. Why? Because on our current, the chart on the left is just highlighting on current programs, on current policies, yes, we're very close to peak consumption in coal, but we don't reduce coal consumption much for that. Look at the level of coal that means. Look at oil. Oil's involved with transport. We can't replace it in aeroplanes. We can't replace it in shipping. And even if we can, it's expensive to do so through synthetics or biofuels. Oil consumption peak is still some time off, and LNG is a little bit further. Also note, out to 2050, just how much the large share of oil and LNG is still there. You can see rising renewables, you can see rising coming through and it taking back, but on current policies, on current programs that are implemented, we don't get anywhere near close to net zero by 2050. Now let's even say we have aggressive policies. And this is why there's a lack of investment in carbon-based energy at the moment, because this is the potential what could move. If that's the case, we have seen peak coal in consumption. It's about to fall. We're not near peak oil yet, and we're not near peak gas, but we're getting close. And you do watch the rather fast tail off over the next 20 years for those two consumption goods. But then still notice, they still make up a significant share of energy mix out at 2050, even if we have policies towards net zero. So yes, there's a lot of fear of having stranded assets. But one of the things you notice in commodity markets that history has taught us is when supply of something, when everyone knows demand for something is falling, supply falls as well, and prices can continue to rise. Mercury, prices rise every year even though demand falls every year. So just watch this space. I'm not saying we should be investing heavily in carbon-based energy. I think we should not be investing heavily in carbon-based energy. But what I'm trying to highlight is countries like PNG and Australia will still get benefit from their current investments they've got from carbon-based energy because the demand will still be there and there'll be a lack of investment around the world. And just to highlight that, this is just oil supply. OPEC is not a source of growth in oil supply. All the growth in oil supply is coming from the Western world, from the developed world, from the non-OPECs, and that's where we sort of live. And that does mean we're going to have high energy prices. This is just real oil prices adjusted for inflation, highlighting that we expect oil prices to remain elevated. And that's continuing through a whole bunch of commodities. Do not forget, copper is needed for the electrification of the world. There is not enough of it in the world. We can debate nickel. It's used in batteries. It's being moved away. Less and less share of the cars have nickel-based batteries now. But anyway, it's still highlighting that that's an uncertainty, but definitely for things like copper, ongoing robust prices for the next decade as we make this massive investment. So resources, I've talked about, dominate the PNG mindset, but please do not forget the domestic economy. You see a lot of people talking about the big swings that are driven by the resource sector. I just want to focus on the black line, the domestic economy. Yes, COVID hit, but it never actually completely retracted. You can see that the rebound from COVID, even though resources was going backwards, almost produced a solid growth cycle in 2021, because of domestic demand. And yes, it's fallen back away, and now the forecasts are around 2.5%. I look at that and I think I get two messages straight away. One, there's an underlying stability based around agriculture and domestic production, that it produces stability in the PNG economy. And two, 2.5% is hardly anything. There's potential to really improve that growth rate. 2.5 in a developing economy is slow. So it just gives you massive opportunities to do more. So two messages. One, it's stable. Two, it offers great potential. And of course, underlying that, the resource sector is about to give us more. So the kina is a managed economy, is a managed currency, and yes, it is overvalued. And yes, we think it will depreciate, but in a gradual way. Just a quick chart highlighting, I think you've probably seen it before today, just the fact the real exchange rate has been appreciating while the nominal exchange rate's being held steady. Just highlighting the degree of undervaluation. Also, the chart on the right is highlighting another issue that's associated with it and why the kina is under pressure. The resources share of government revenue is shrinking in PNG as a share. That means they need to get resources from elsewhere. That's putting pressure on the kina and part of the reason why we're seeing a managed currency. Our forecasts are just for gradual depreciation over time, highlighting in this chart with the red line, just gradually eating away. It's going to be a managed sustain. Why do we need to do this? Because we need more liquidity in the system. There's a lack of kina. You've seen it in the constraint around investment, the constraints around supply. So two things have come out of this in one sense. One term, we know there's excess kina in the system, so banks like us don't offer great deposit rates, nor are you seeing the rate of interest around in PNG being that high, relatively speaking, because there's excess kina looking for a home. It's helped spur on domestic investment because excess kina is living and people got to do something with it. But it's restricting investment into PNG, and it's restricting definitely imports as well. And why it's also going to be managed is because, as you know, if you're on the import side, declining kina raises prices. So on one side we need a lower kina, but we don't want it too low. And just to finish up, was just that I was talking there about the FX issues with the kina. And so that evolution has come through. It's quite acute. What I do want to highlight, however, is our own survey that we did with Business Advantage earlier this year is just highlighting this issue, that FX became the #1 issue out there, even more so than inflation, even more so than capital constraints, business priorities. Kina was the #1 constraint on businesses in PNG. And that is why we need the gradual revolution of time. Yes, there is potential for the kina to be resolved through the paying down all of the debt that's associated with the resources sector, and that fund's coming through. Yes, there's potential for the new projects to come in after they've gone through the investment cycle to bring a lot more foreign dollars into as well. All those are there, potentially could restabilise the system and lead to an appreciating kina somewhere down the track. But we've got to get there. And we need the liquidity in the system to help boost domestic demand and get growth going. So they're my 6 quick points. Global outlook is improving and more constructive. We are past the peak in global inflationary pressures. The transition away from a carbon-based economy is happening, and it matters for resources. Resources dominate the mindset in PNG, but please do consider the domestic economy. Kina's managed currency, it's created problems around liquidity, and the FX management of that has created a FX shortage, which has given us excess kina. If you need some research from us, you can find it online. Westpac IQ, just Google it, all our research is free, or Westpac Wire. And just quickly, 2 pages of disclaimers to make sure that you can, and I will have my at the bottom here, if you've got any questions, you can reach out to me. But the whole point of this presentation is not to give you solid answers and say, do this. It is to put out these ideas of what we think is a most likely scenario, give you some ideas and thoughts to debate around policy and investments. And for me, if you come and tell me later on that I had some good ideas, but you disagree with me for this reason, I'll be very thankful, because that's how I think my job should be. Make you think, and make you think about what's right. Thank you. Yeah, sure.
Thank you very much, Justin. Before we let you go off stage, we've had a couple of questions via the app for you, so I wonder if we can deal with them. The first one is really about, I think, how PNG is perceived internationally. So from the outside, what view do people have of the economy? Is it of a developing country which is driven by carbon projects but is looking to diversify? What would you comment on that?
Yeah, I find that one of the more frustrating things, actually, I have to agree, that the mindset on PNG is resources. Yes, resource rich, tap into it, use it to your advantage. It is the natural wealth of the nation which should be exploited for the people of PNG. Agree 100%. But has it diverted attention away? Is it the classic sort of Dutch disease where you've got this booming export sector that dominates the mindset and prevents people from thinking more deeply about developing their human capital? The examples I will use is countries like Taiwan, Israel, countries that have no resources and rely on their people. And they've become wealthy, developed economies because they focus on developing their people. So yes, I would suggest that resources are a boon and a curse.
And the other one here, just these are both anonymous questions, incidentally. You can identify yourself if you want to. We've been hearing the call to focus on or develop the domestic market, especially in agriculture, for so long, but no real action. Well, I think we're hearing a little bit at the conference. Is the resources mindset holding us back? And I guess that taps into your first answer.
It does. And I do actually sort of, my first job when I first left high school was agriculture. And so I still have I used to be a farm consultant. And so I got a very strong love of agriculture and development that way. I go to PNG and I just see the potential that is huge. And I see the lack of resources, both human and physical, that are holding back development in agriculture. And so yes, I think there's a lot of potential to do more, both in developing the domestic market so you don't have to import so many supplies, particularly into Moresby and Lae, and also developing export markets as well. Potential's huge, but we need the development not just in resources, but in human capital as well. People need education to be able to engage in this kind of activity. So the potential's huge, and I believe the motivation is there, and I can see it with the people. It just needs a bit of help.